In this presentation, we'll be looking at several types of decisions. In each of these decisions, we follow a simple 5-step process to determine how to make the appropriate decision. First, we'll analyze the objective of the decision. What are we trying to decide? Second, we'll identify all the alternatives that we can pick from. Third, we gather all the important information. Step 4 is to make a decision. And then step 5 is to analyze the results of this decision. The next decision we'll look at is whether to continue with a segment that's losing money. So, should we discontinue a segment? Remember, a segment is a piece of a business. In this example, we're looking at cereal. And there's cornflakes, toasted oats, or bran flakes. And you can see the bran flakes are losing money. So we need to decide, should we keep this segment of the business or just drop it and get rid of it and just continue on with just the cornflakes and the toasted oats? So to look at this, we have to analyze and build that simple income statement showing what happens if we continue with the bran flakes? What happens if we discontinue those bran flakes? And the differential effect on these alternatives. Some things to note here are what expenses would we have to continue paying even if we dropped that segment of the business. And typically your fixed expenses would have to continue even if you drop that segment of the business. So in this case, we look and see that our bran flakes have a total fixed cost of $26,000. We can say, well, we're only losing right now $11,000. So we should know just from comparing our fixed cost to our current loss that we should continue with this segment. But let's take a look at it by preparing our simple income statement. First, if we decide to continue with the bran flakes, we include those revenues and the costs associated with it, showing that loss of $11,000. If we decide to discontinue, all of those revenues would go away, as would the variable costs. But we would continue to pay those fixed costs even if we discontinue this segment. Therefore, we're losing $26,000. And we should probably continue with this segment even though it's losing money. We can then show our differential effect based on choosing alternative 2 by subtracting alternative 1 from alternative 2 from alternative 1 to see what impact this would have on our income. Another decision that we can look at is whether we should replace an asset or just continue with our old machine that we're working with currently. And when we look at this decision, we again prepare these very simple income statements that show the differences in these alternatives. First, let's look at if we decide to continue with this old machine. We would not have any cash coming in from a sale because we're going to keep it. Then we'll look at the costs associated with it. We only have the variable cost of this machine, and since we're comparing this on a 5-year basis because that's the estimated useful life, we would include all those costs associated with those 5 years. Therefore, if we continue with this old machine, it would cost us $1.125 million to continue with this. Alternatively, if we replace this machine, we'll get some cash flow from the sale of the old machine, but we have to purchase a new machine, and that purchase price is $250,000. Over the next 5 years, it would cost us $750,000 to operate this machine, giving us a total cost of $975,000 if we did decide to replace this machine. I want you to note that book value, along with any initial cost and accumulated depreciation of our old machine is not a relevant cost and should not be considered. Finally, we compare replacing this old machine with continuing with it and look at that effect it would have on our net income. The choice here would be to replace the old machine since it would produce a cost savings. Our next decision that we'll look at is whether we should sell something as it is or process it further into a new product that could probably be sold for more revenue. In this example here, we're looking at kerosene, and should we sell it as is or produce it further to yield gasoline? Now, we have to look at how much we can gain by just selling it as is. So again, we're going to produce a simple income statement showing the revenues, costs associated with it, and income if we decide to just sell that kerosene as is. So since the kerosene, we have 4,000 gallons of it to sell, and each one is selling at $2.50, we would have revenues of $10,000. The costs associated with that are $2,400. Therefore, our income is $7,600 if we decide to sell it as is. Now, looking at processing it further, we have to consider some additional costs. So originally we have 4,000 gallons of kerosene, but once we turn this into gasoline, 20% of that evaporates. Therefore, we only have 3,200 gallons that would produce gasoline. We look at the selling price of this, and we take 3,200 times $3.50 to get our revenues. We'll look at the cost associated per batch, which is $3,050, and we can see that we have an income of $8,150. Therefore, looking at these two alternatives, we would have additional income of $550 if we choose to process it further into gasoline, and that should be our decision. Another decision that managers have to make is whether to make a product or to just buy it. And some things we have to consider is, first, can the factory or does the factory have the capacity to make additional products? And or if we do decide to buy it, can this empty space be used to produce something different? Those are all decisions that we have to consider. But initially, we should look at the cost per unit and what is that cost per unit if we make it or if we buy it. And we have to consider what cost would we have to pay even if we decide to buy it. When we analyze the unit cost between making a product and buying a product, there's one piece that sticks out, and that's that fixed factory overhead. Remember, that fixed factory overhead we have to pay whether we make these panels or buy them. So therefore, that cost is going to get paid. So when we consider the cost of buying these panels, we need to add that fixed factory overhead into that cost. Because even if we're purchasing it for a cheaper price, we still have to pay that fixed factory overhead. Whereas if we make it, that fixed factory overhead is part of that unit cost. So now looking at these two alternatives, it is cheaper by $28 to make the panel rather than buy it. And finally, the last decision that we're going to look at is whether or not we should accept business at a special price. This business is in addition to our normal business and would not affect our demand. Again, we have to make sure we have the capacity to accept this additional business. And if we do, then we can look at what price is our customer willing to pay us. And as long as that price is over our variable costs, then we should take this business. Because if you think about it, those fixed costs have to get paid whether or not we take this special business. So therefore, those fixed costs that have to get paid anyway should not be considered in evaluating this decision. So again, we'll perform that very simple income statement looking at if we decide to not take this order versus if we decide to accept this order, and the differential income on those alternatives. If we decide to reject this order, we're not going to get any revenue, but we won't have any costs, so that will all be zero. If we decide to accept it, we'll have additional revenue of $90,000. This is because they're willing to pay $18 for 5,000 basketballs. The variable costs include $12.50. Again, we're not looking at those fixed costs because those are already paid with our normal selling. Therefore, our total cost should be $12.50 times those 5,000 units. Our income, if we accept this business, would increase by $27,500, and therefore we should accept this additional business. The only reason you would not accept any additional business is if the price that the customer is willing to pay does not cover those variable costs.